Welcome back to Vantage. We are looking at thematic investing, a fascinating area. We've got a couple of veteran investors with us. Welcome for the first time to the show. Do you want to introduce yourself and the fund to start off with?
Peter Martin, manager. We are of the Oberon Theseus Fund.
Toby Clothier, co-managers. Our background is in equities. Peter's been doing equities for 40 years. I've been doing equities for 33 years in various different guises. And we met 15 years ago because Peter was a client of mine and we became friends, and then we decided to join up, and here we are.
Yeah, okay. And you launched a fund in March, so it's early days.
January,
soft launch in January.
Okay.
March was the launch which you kindly came to and introduced.
Yeah.
So we've been going for about 4 or 5 months, but we've been running money since August last year, all based on the model that we do centralize everything, because we do various things apart from the fund as well.
Okay.
So the thematics, it's still a short period of time, but based on our 40-year track record.
And you hinted at that. It's thematics sit at the heart of this fund. Why thematics? What's the what's the edge that gives you?
So the general thinking, and I worked at a firm that did things this way for 10 years plus previously. The general thinking is that at any given time, there are only a certain number of things that are very interesting. An example would be defense, which we both thought was very interesting 5 years ago. But if you can find 5 or 6 themes like that that are very current and that are moving and things are happening and the timing is good, that allows you to focus quite hard on those things, and it allows you to not focus on all the other things that are happening in the world that are not interesting. So you essentially free up time by not having to look at everything, and you increase your focus, I think, by only looking at the half a dozen things that you think are super interesting.
And I think we decided that coming back that we were both very good at picking stocks. Active management has been in the doldrums for some time, due to the great success of passive, to be fair. It's 60% of US mutual fund money, investing money. So we think active has now come back onto the stage because there is all the fund management groups have got so big, and they treat your clients fairly and so forth. They can't look at various areas in the market or even mid-cap stocks, which are so interesting and where we find a lot of value.
Okay, so you're hunting for sort of gems out there.
Hidden treasure.
Yeah, exactly.
Hidden treasure.
Yeah. And interestingly, I mean, you're both invested in the fund, so you're backing yourself. A great time to launch. I mean, you've been through a fairly sort of turbulent sort of first sort of 5-6 months of this year. When I looked at your sort of deck, it sort of drew a stark contrast between the world in sort of January and February, falling bond yields, moderating inflation, oil at sort of 60, 65. And then what happened after the conflict? So oil much higher, inflation accelerating, bond yields rising. We get a lot of retail investors taking a look at our content. For those trying to make sense of the world and how you sort of think about that sort of regime change and how that's influenced your investing decisions, love to hear about how you're thinking about it.
Very good question. So let's talk about 2026. First of all, it's been quite unusual. You said it's a good time to launch. We certainly picked a eventful time to launch.
Yeah.
So we position ourselves at the beginning of the year for the world that we saw then, as you said. Inflation declining, consumers recovering, expectations of interest rate cuts, emerging markets picking up quite strongly, commodity cycle doing very well, gold stocks doing very well, gold doing very well, etc. And that was how it was in January and February, essentially. And actually in February, the fund was up 6%. Which was our first full month. So we were both very happy and patting ourselves on the back. And then obviously the world completely changed, more or less overnight.
Yeah.
And we went into this new world that we've been in for March, April, May, and maybe June, we'll see. And the positioning you need for that new world is different, obviously, because everything gets turned on its head. It all starts with oil. Oil leads to inflation. Inflation leads to worries about rate hikes. Rate hikes lead to lots of sectors that we quite like doing badly. And actually, ultimately, everybody kind of fled into the things that they love most fundamentally for the last 10 years, which is the US and tech, right? Because they're both kind of, the US is a long way from the conflict and tech is kind of safe. Well, We can talk about it later. Maybe it's not so safe, but anyway. So that's a different world, and so we've had to kind of amend, but not completely destroy our positioning, to take account of the fact we seem to be in this new environment. And then the $1 trillion question we talked about before is, does this go on forever? We think it doesn't. Does it go on for another 3 months? We think probably not. Is it maybe over? Quite possibly. So that obviously then opens the door to get back to the kind of positioning we had in the beginning before this nightmare came along. And if that unfolds in that way, the fund will probably do quite well.
Yeah, it's an interesting sort of positioning, that, because you can't predict what is going to happen, but you'd need to position yourself in a way that, depending on outcome, you're still winning. So how are you sort of thinking about that? So I know that you've got sort of laid out the different paths that we sort of get to. How are you actually investing on the basis of you might go down one route or another?
So it's been difficult is the first thing, and we've been bouncing around, not really going anywhere, particularly for a couple of months, because we're trying to protect against it carrying on, because it's possible. We've had some defense stocks, we've had some oil stocks, we've had a bit of cash, we've had some treasuries, because it might go on and on and on. But fundamentally, we think it probably won't. So we're kind of tempted to tilt back towards how we were in the beginning.
Yeah.
And maybe things will.
So we created, and I say we didn't see the severity of this or timing of the war coming. We saw it coming, and we did have a 70s playbook within the portfolio. So we were overweight oil, which has helped the fund. Overweight, if you look back into the 70s, gold, property, that was supposed to protect us, because of the way that modern day markets work so well. One of the things we got wrong was our gold equities, which we still hold, but they were just traded as a block because they've been so profitable for the last 12 months. Yeah. There were these very big sell-offs in various asset classes and very big ups in oil and so forth. And then, you've seen other things which we haven't been involved in, like the big move in software, which we've just simply not been interested in playing in. Yeah. And you're getting these big swings, and it makes it terribly difficult. So we're trying to stay position for the medium term through all this, and still making money, but not as much as it is with our friends, Mr. Musk, which we'll come on to, and so forth. But we have views on that, and so we've basically had a foot in both camps.
Yeah. Okay. Interesting. One of the striking things, and actually one that I really like, is your idea around gold and mining M&A. It looks like be a sort of big part of the portfolio. Yeah. Compelling in terms of when you rationalize and talk through it. Would love to get you to talk a little bit more about it, and also you to reflect on, perhaps, if you're seeing it, how come the rest of the market's not necessarily seeing it?
So this is one of my 3 favorite topics. So how long have you got? So look, there's a gold mining cycle. Yeah. It starts with gold picking up, which happened 3 years ago, probably. Then people start buying streamers, so the big so Wheaton, precious metals, these kind of things, because they don't want to take the individual risk in the individual mines. And then they get a bit braver and they want to buy the big, the Newmonts and so on, the Barracks of this world. And that's another phase. And then there comes a point where everyone is making lots of cash flow, like really a lot, and they've all repaired their balance sheets. But the big guys are not really growing as fast as everyone would like. So if you look at the top 15 gold miners, only 12 of them are really, only 3 of them are growing production and 12 are not really. And then there comes a point where the intermediates also start making a lot of money and typically grow faster and have repaired their balance sheets. And they're trading at maybe a third, maybe a half, in some cases, maybe a quarter of the multiples of the big guys. And so that's the sweet spot for M&A. And to be fair, in the last 5 years, there've been probably 50 deals globally that are notable. Yeah. There were a bunch last year. There's been already half dozen this year. But when you look at the numbers, I sort of wish I was a gold mining M&A banker, because if you're trading at, let's say, 15 times EBITDA or 20 times earnings, and you're, say, Newmont, is very big and not growing, and you're looking at the intermediates, there are dozens that are trading at 3, 4, 5 times EBITDA, or let's say 7, 8, 9 times earnings. They actually have dividends. They have enormous free cash flow yields, about 15, 20, 25% in some cases. And so any deal you did, even at a 30% premium, would be immediately, instantly accretive in a major way. And so the way we're positioned now is not necessarily we're in love with gold, because gold is fine. Anywhere above 4,000, everyone's in a very good place.
Yeah.
Because you have 2,000 plus margins. We're not interested in the streamers because that part of the cycle is past. We're not very interested in the senior miners because we think they're the acquirers on the whole. But we are very interested in the intermediates that we think will get a bid for. And there are literally too many to choose from. So we have, I think, 12.
Names like, correct me if I'm wrong, but things like Endeavour, I-80 sit within the portfolio?
Endeavour, no. Actually, I'm not quite sure where that came from. I think maybe it was on a deck of things we like, but we never actually owned it. So we own, I-80 is a good example.
Yeah.
So they have 10 billion approximately of assets according to the MPV.
Yeah.
And the EV of the company is 2 billion.
Yeah.
It's quite a big gap. They're in Nevada, which is the world's best mining jurisdiction. They're down the road from Nevada Gold Mines, which is a big joint venture between Barrick and Newmont. So that would be quite an interesting add-on acquisition maybe at some point. So there, and there are others that have some exposure to Africa. And people always say, why would you mine gold in Africa? It's crazy. And they obviously have forgotten that the richest man in the world at one point was the king of Mali, Mansa Musa.
Yeah.
There's a lot of gold in Mali, but obviously there's political issues all over Africa and geopolitical problems. So anything which has even a tinge of Africa trades at silly multiples, 2 times EBITDA, maybe 3, and consequently has 20, 25, 30% free cash flow yields in some cases. And nobody wants to know, which is fine. But the Chinese have always liked Africa, and particularly West Africa, mainly because nobody messes with them. So if they actually buy things, then life carries on and nobody wants to interfere. So the Chinese potentially could buy an awful lot of things in West Africa, which we think is quite likely.
Okay.
I think another thing, which is always a box we like to tick when a theme, Neil, is the street doesn't cover it.
Yeah.
There are the people that Toby and I speak to are Canadian brokers who get on a plane and come over here. If you talk to the mainstream banks or whatever, nobody's really
interest levels are still
exceptionally low.
Yeah.
And so that's always an opportunity.
Which is a good thing.
Defense, where there was one defense analyst left when the tanks rolled into Ukraine. Now there are
many,
several, and there is a sort of sequence to events, and that's one of the things we like to see before we go into that. It's unloved, and again, it's a question of size, liquidity, and also the way that fund managers have been investing, using very much, ETFs, leveraged products to get into gold, and not necessarily trying to pick stocks, because as a benchmark basis, it's still under 1% of our, say, an MSCI world. So there is that business consequence to coverage in the research departments, and so it's an opportunity.
So there's actually, just on the interest thing, so we do like it when people are not interested in something, because that in itself tells you quite a lot. I have personally sat down, and Peter's joined some of these meetings with at least 100 gold CEOs and CFOs and IR people in the last 2-3 years. And we're getting those meetings quite easily because nobody cares. So essentially the people bringing them to town quite often are looking for a bum on a seat, but one way. And we're like, yes, we'd love to see them, and we have these great meetings, and literally nobody else cares, which is great. The flip side of nobody caring is that things can obviously stay cheap ad infinitum. But that's where the free cash flow comes in, because the free cash flow yields have got so high, and they're all determined to not do the mistakes of 2010, 2011, which was a horror show for the whole sector. And so they are aggressively buying back stock. So Newmont, for example, just finished a $3 billion buyback middle of last year. They immediately launched a new $6 billion buyback, so twice the size. The market cap is 100 billion. You can do the maths. When that finishes, I'm sure they will immediately launch another probably 6 billion buyback. So they are aggressively buying back their stock. And people used to say the same thing about the tobacco industry, that they're all busy buying back their stock, and in 10 years there'll be no stock left, and so on. That applies to the gold miners, but gold mining doesn't give you cancer. So maybe it's better.
And I think also, hopefully, if peace is signed this weekend with Iran, we will see interest in gold rebuilding up, given the fundamentals of why in the G7 meeting they're all trying to deal with their pretty awful balance sheets, and gold, several central banks have said they are still ongoing buyers of gold. So it's, as the original investment theme, it still stands once this is all put to bed in the Middle East.
And just to tie it back to the water, as it's all connected, I don't think people expected some of the central banks to start selling any gold, because they've all just been in buy mode forever. And it turns out that Turkey and I think recently Indonesia have both been selling, or actually swapping in some cases, gold on a sort of short-term basis. So they might want to swap it back at some point. But they have both been weakening the market a little bit, because they're trying to defend their currencies, because everyone's piled into the dollar and they've piled out of the rupiah and the Turkish currency as well. So there has been some central bank selling as a result of the war, but actually the Chinese, the Uzbeks, the Poles, I mean, everybody is essentially still in buy mode. So we feel like that's ongoing, and the small amount of selling will abate or even reverse if the war is definitively over, because the currencies will recover, the dollar will probably weaken, etc., etc. So there may be, having been a lot of headwinds for gold itself, there may be some tailwinds coming, which obviously would be helpful if you're...
Yeah, really good point there. Let's pivot. Okay, you've talked about the unloved. Now let's go to the other extreme, the loved, the loved, right? So there seems to be only sort of one game in time. And one of the things I find fascinating is you're refreshingly honest. You do have exposure to AI, mainly in the sort of picks and shovels, TSMC, ASML, but you sort of labeled it as part of the AI bubble. So again, I think it was a very sort of interesting sort of positioning. I'd love you to sort of articulate that a little bit more. And I guess probably the most important sort of question is, you got exposure. You think by the mention of bubble, it's stretching. It's really about, what are you looking for in terms of when you start trimming the position?
This is my second favourite ticket. Piece of nose, I bang on about this all day long. So first of all, my entire career, bubbles have followed me around. Like, it's like a sort of dog that bites your ankle all the time. Everywhere I go, there's a bubble which then blows up and so on. So it's a topic of much interest. So I think the best way of explaining how we think about it is that the bubble is in the expenditure.
Yeah.
The amount of money that is being spent, that is going to go from 700 billion to a trillion to 1.3 trillion to whatever, 10 trillion probably ultimately. So that money, I explained it to my son the other day because he's doing economics, as thinking, if you think of it like a bath, so that money is the taps, and there are 6 taps and they're all on full blast, full temperature. There's a lot of water coming out. Everyone who's the recipient is in the bath having a nice time. There's lots of nice hot water. It's all incredible. And it's a big party and, infinity and beyond. So we are in the bath as well, because ASML's in the bath, TSMC's in the bath. They're like, this is great. Life is amazing. The problem is that if you look at the share price performance of the people who are responsible for putting all that water in the bath in the first place, so Meta, Microsoft, Amazon, etc., they are going down. In a raging bull market, they are not going up, they're going down.
Yeah.
And the reason they're going down is because people are worried that they have spent all their money, which they have.
Yeah.
They've all gone from net cash to not. No more buybacks, no more dividends. They've also exhausted the bond markets because everyone is very bored of hyperscaler bonds, of which there are now 660 billion. It's quite a big number.
It is.
So the bond market is bored of those, and they keep on trying to issue them, but there's less and less appetite, and they have to pay higher and higher
The bond market's closed.
So that's almost closed. And so now they're going to shareholders and saying, please, can we have 80 billion because we want to spend it on this? And the shareholders are like, well, did it work last time? Is it working? What's the ROI? Who knows? They're kind of putting the money up because it's, in some cases, a small percentage. So 80 billion, if you're Google and you're at 4 trillion market cap, is 2%. You can get away with it. Yeah. If you're Oracle and you're 500-600 billion and you want 100 billion, that's a slightly different dynamic.
Yeah.
So we think that as time goes on, the vehicle for raising that money, i.e. the equities themselves, will become kind of problematic for shareholders, for the share price, for everything else. And so people are going to have to look much harder at what they're spending. What is the ROI? Is it a good idea? Talk to shareholders, talk to the board. Are we doing the right thing? And there is a very good chance that the taps basically get dialed down a bit. And that's the point where we will be selling our picks and shovels and moving into something completely different.
I mean, it's 92% of US growth.
Yeah.
And if you
AI
look at
capex.
Yeah. And if you look at the S&P valuations and so forth, I think you've seen that chart we've stolen from the amazing Howard Marks, and it says, basically saying, you look at history, at this level of valuation, you won't make money in the US market for the next 10 years.
Yeah. And that's without an AI capex bubble, which may be about to
continue,
start eroding.
Certainly, yeah. And so it's also quite, and again, with this 72% of the world's index stuck in Donald Trump's land, it's all getting very concentrated. And when these things unwind, they will really unwind. And I think the other point, Toby, I know that you're bound to talk about SpaceX in a minute, but that Toby wrote a very good note saying when you get to 100 times sales, there's only 4 companies, the other 3 have gone down 90% over the next decade or so. So, you know, what were you thinking, as he put in his article? But it's you know, there are retail investors who don't look at valuation, and I think it depends on the type of money. You know, someone had given me some SpaceX, of course I would have accepted it, but if you're going to put pension fund money, retail, proper long-term investment money, it doesn't make any sense to us.
I think SpaceX deserves its own special section. Probably,
Yeah.
Just one other thing on the AI capex. So there's 2 reasons that the Bath taps could potentially be dialed down. Firstly, the companies see sense.
Yeah.
And actually, of the hyperscalers, Microsoft is probably the most sensible. And Satya Nadella has done various podcasts and things in the last year or so where he's talked about how potentially there is a lot of capacity coming, and you know, maybe people have done it a bit. So they have their full year numbers in July, which is when they normally announce their capex for the next 12 months. And nobody is expecting them to do anything except grow it by 40% or 50% or whatever. If he were to say, actually, we found more efficient ways of doing things, perhaps we've got enough capacity for now, blah, blah, blah. And even if they grew it by 10% less, so say 40% or 50% or whatever, that is a big signal for and everybody would then probably copy, because everybody likes to do what everyone else does in Silicon Valley. So that would be a big signal for generally a bit less capex. Everyone fiddles with their models and goes, oh, hang on, this means the growth rates for all the recipients in the bathtub has slowed down, and that's the beginning of something. Separately, there are severe logistic problems with data centers in the States.
And so data centers, the other canary.
Which people are completely oblivious to, as far as I can see. So 11 states so far, and counting, have either banned completely the construction of new data centers on environmental grounds, or are thinking about banning, putting through legislation now, which will, etc. So partly because of that, 60% of the data center capacity that is supposed to be on stream by the end of 2027 has literally not even begun being constructed yet. And it's June. So end of 27 is 18 months away. It takes 2 years. So we are clearly behind, and fueling the fire is a lady called Erin Brockovich. I'm sure you and most of your viewers will have come across. So her thing is they use up too much water, they use up too much electricity. They are also incredibly noisy, which a lot of people are unaware of because of the gas turbines inside that they need to cool and so on. You can hear them a mile away. So it's a bit of a problem. And that whole movement is gathering pace. And people are rapidly working out that data centers in your town, area, county, state are bad. So it's all very well for Zuckerberg to say, we're going to spend 150 billion on data centers next year and the year after, whatever. If you can't actually build them, although obviously Elon will be building in this space, so let's not panic too much. But if you can't build them, it is a problem.
Yeah. Let's move back to home territory. We're based in the UK, and a portion of your portfolio is actually invested in the UK M&A theme, which, you know, you can't escape the headlines. If you've been living here for the last 3 years, you continue to see sort of companies, great companies, being taken off the market. So how are you positioning yourself? So, would like to understand, why are we seeing so much UK M&A? Two, how are you positioning yourself? Are there particular sectors, areas, or sort of valuation parameters that you're looking for? And, I guess it's one of those things that you would have heard the story many, many times that the UK is cheap, the UK is cheap. And I'd love to get your take as to, why is it different this time?
Yeah. So, so we both like the UK. We obviously live here. We probably know more about UK companies in general than companies elsewhere, possible exception of the States. But so this theme is actually, I'm glad you mentioned it, because this theme is 5 years old now. This was a theme at my previous firm. It started in 21, 22 maybe. So this is a very, very long-standing thing. And the key sort of big picture thing is possibly because of Brexit, possibly that led to outflows, which are still ongoing because everyone's worried that the UK is going to sink into the sea. Possibly because people are obsessed with tech and the UK doesn't have so much tech. Possibly because our domestic pension funds don't really care about the UK and we invest 2 or 3% of their assets in the UK versus 40 in Italy, for example. So there's all these kind of big picture flow and technical effects which mean that money leaves rather than arrives in the UK. And so consequently share prices tend to go down and there's an awful lot of negative sentiment. AIM has obviously been a disaster, as our colleague Richard Penny likes to point out. But there comes a point where corporates and private equity companies look at the numbers and they say this company in the US is here and this company in the UK is here, and they do the same thing and one is at a 50% premium to the other. Doesn't make any sense, so we'll buy them. And so there's been a lot of incoming US M&A, and the private equity guys just look at the numbers and say the IRR is 40% if we bid a 40% premium, so let's do it.
Yeah, and it's, I mean, remember, we've always been the aircraft carrier of Europe. We speak English, America. The money comes from the States, from the private equity business. You're looking at 12 times versus 22 times, and just in terms of market index. A lot of the FTSE or the bigger 250 companies are not domestic UK businesses. I mean, we live in a time where everybody's moaning about the UK for the politics and all that sort of thing, and we're sitting here ahead of Macclesfield tomorrow night. But that doesn't impact a lot of the global businesses, and because of American money has nowhere to go, they look for business, and and the market's been shrinking and shrinking. Public equity.
So there's other
down.
Yeah, there's other drivers, and the English thing is the important one. So you'll notice there's been a lot more M&A in the UK than there has been elsewhere in Europe.
Yeah.
It's not a Europe thing; it's a UK thing. Yeah. So the language is part of it. I think there are a lot of very well managed companies, and we see small and mid-cap companies all the time, and there's a lot that are very good companies and they're well managed and they have high profit margins and they have good balance sheets and so on. And I think because the sentiment around the UK is so bad, the money doesn't come, so they get cheaper and cheaper and cheaper, and then eventually it gets too much and off we go. So how we approach it, and there's been 18 companies that we've liked in the last sort of 4 or 5 years between us that have been bid for, but we tend to look at the numbers. Yeah. And when we find things that are trading at half their NAV, with a recent example being EasyJet, which we owned. Yeah. And the reason we owned it is because their assets are worth 5 billion and the market cap was 2.5. And they also have 500 million of cash. So there's a gap. And the sentiment around it was terrible because of the war. It's a UK consumer play, rates, Rachel Reeves, bond market. I mean, fuel, you name it. There's all sorts of reasons why the earnings were not particularly special this year particularly. And so people are like, oh, not making much money, it's terrible. But if a hotel is empty, the building is still a hotel and worth quite a lot, even if it's got very few guests, right? So EasyJet was essentially an empty hotel, which is worth 2x the share price. And it looks like, we'll see, but it looks like somebody or some bodies have, seen that opportunity and here we are.
Yeah, and there are PE firms who've been involved. I mean, airlines, let's not kid ourselves, a very difficult industry, but they've had experience. Yeah. They've got to the 26th of June, and, it's recovered basically. It's interesting, the prices are actually recovered to where it was just before the war. Yeah. So we were on a sort of plane. So it was a hard one for us to hold. We've been gently adding into the recovery. It was painful.
But, you know,
going back to the January launch, as you said.
Richard owns it also for the same reasons. And we were sitting there saying, this is at half its asset value. I mean, how much lower can it go? At a time when there's a shortage of airplanes, by the way. If you want a new airplane in Europe now, it's 2032. So this is about 365, I think, last time I looked, of which they're in 240. New planes sitting there at half price. I mean, that's crazy.
Plus, their capex cycle is coming to at the end, etc. So actually, this year's earnings are slightly depressed in terms of, and so someone's smart to look at that.
Another one, and I'm not pumping the stocks that we own, but just it's a good example. Am I allowed to pump the stocks we own? Who knows? Anyway, no. Okay, so I'm definitely not pumping this. Don't buy it, kids. So the NAV of one of the nameless property companies that we quite like is £5.34. The share price is £3.20, which we give some of your viewers a clue if they know their REITs. And I saw the company last week, and I said, look, what's going on? You know, you're selling buildings from time to time at par NAV or even above, and your share price is, you know, there's a 60% gap between the two. What are we doing? You know, what's going on? And he said, you know, Brexit, flows, property, government, bond yields. I mean, they're not even very levered, so that's kind of relevant. But anyway, so the sentiment around the thing is terrible. But in the real world, they're selling buildings every other month at par in Hanover Square or wherever. That's true. And their share price is completely disconnected. So, you know, at some point, unless they fix it themselves by selling lots of property and doing buybacks or special dividends or whatever, which might equalize it, at some point, the Kuwaitis or the Saudis or somebody will probably come along and do it for them.
I mean, property is, I mean, you remember from our launch, Neil, property has just been a terrible investment for the last 10 years, either whether it's commercial or residential. And that's been a big change in investor outlook. It's easier for us in meetings to say, you know, equities can be frightening for people, and it was always property was always a sensible thing. But nobody's made it. They haven't beaten inflation. They've all lost money, and you know, we're an island nation, and so there's lots of things and changes going on, which I think will be very positive for the UK equity market.
And back to this one, it's commercial property. It's prime central London. Nobody's working from home anymore. Well, maybe some people in the government are, but most people in the private sector are not. They just leased, they just did a 15-year lease with Glencore and Richemont on the same building 2 weeks ago at £260 a square foot. So that isn't crisis type stuff. That's full on, full tilt, prime, going at prime prices, and yet the share price.
And that in the 70s was an asset class that did very well because of this reason. It's to say, history does repeat, hard assets do, and that's part of the commodity cycle as well, if you talk about that as well. So it's all positive, but these are areas which have been unpopular whilst the Middle East has been kicking off.
Yeah, I am going to come back to that and the unpopularity. But first, let me ask you, so given how we talked about some of the ways you positioned the fund, let's for some balance, you know, what's the thing that you're scared of happening in the world that would sort of impact performance for you? Is there a particular event or?
I mean, if SpaceX were to issue $100 trillion of stock and buy every company in the world, and then you had a choice about buying SpaceX or not, that would be a tricky one.
Yeah.
Hopefully that's probably not going to happen. But I think we're not that big on proper bubbles, as in companies which have no value going to the moon, literally or figuratively. And so the more that happens, the more the benchmark tends to go up. And so everybody in institutional fund management ends up going, what do I do? Do I chase this thing just because it's going up and everyone else is and I don't want to get left behind? FOMO, essentially. Or do I stick to my guns and say, this is nonsense, I'm going to buy AB Foods or whatever it happens to be. So it would suit our kind of preferences if real companies, Halo, emerging markets, commodities, gold miners, you know, real world stocks did better and kind of most companies on 20, 30, 40 times sales did worse. That would be good for us and vice versa.
And just the obvious basic things like, they're still saying rates could go up, and we don't think so and hope it doesn't. But if rates going up, I mean, obviously our friends in Europe did it again last week, and thank God it was at the same time as the piece, and the market just ignored it. But for 5 minutes it wobbled, and then everybody realised saying, move on up. And then, of course, it leads nicely in tomorrow's by-election. You're saying what would worry us if the bookies tell us that Mr. Burnham is going to win. And we will see what happens. Starmer will probably fight him. That again seems to be the favourite. But if he loses, and we see their policies, and if they go very much to the left and refuse to touch the welfare budget, the UK economy could be in for a sterling crisis. Yields may go up if they borrow too much, and in which case we would have to reassess anything we had in the UK.
Problem is, you might end up jumping out of the frying pan into the fire, because fundamentally, when we think about the world, virtually all Western governments are essentially bankrupt, right? And so there come times where people start worrying about that, and other times where they're not worried about it. The US is about to hit 40 trillion of debt, which is $380,000 per taxpayer, for example. Nobody seems to care. But, fundamentally, there is a kind of government problem, too much debt, too much expenditure, and nobody's doing about it. And so from time to time, when politicians come along who might make that worse, obviously bond markets can take fright. And if bond markets take fright, as we all know, bad things happen.
I mean, I think that, we have this, as you say, this sort of indexation of large stocks that people are following, and to a certain extent it might get a little bit more extreme if Anthropic comes to the market and OpenAI comes to the market, and it's sucking up so much of the oxygen of the rest of the market. But it feels like you're very sort of Buffett-esque in your sort of thinking, which is that, eventually the tide's going to go out, and you've got to be in the places that places that you could defend with valuations fundamentals, right?
So this is very interesting. So I was at what was called Credit Suisse First Boston in 2000, and people have now largely forgotten them, but we had Frank Quattrone, and we had dancing mermaids, and we had karaoke, and we had an IPO every day, and it was all very exciting. And then obviously in 2001 it suddenly became not very exciting at all, and the two sectors that did best were home builders and gold miners, followed by consumer staples. And then, of course, I was at Bear Stearns I made a partner at Bear Stearns in 2005. I was there at 2007. It all looked great. And then, obviously, 2008 came along. And what did best after 2008? Gold miners, home builders. And so Warren Buffett just bought, literally 2 weeks ago, the entirety of a US home builder. So it's pretty clear which way he thinks the wind is blowing. And, after a tech bust, and there will be a bust eventually, it's purely a question of when, rates have a habit of going down a lot. And people have a habit of buying real assets and stocks on P's of 5 or 6 with dividend yields and whatnot. And actually gold miners and home builders do tick both those boxes. So we are kind of positioned already for that something bad.
It is, we started to buy US home builders
literally just last week or so.
But all those stocks, I can remember going back to 2000. Again, this is the muscle memory of two. You're very kind to use the word veteran. Anyway, thank you for that. Super veterans, but we were veterans of the 2000 crash, and then nobody was going to buy BAT. Nobody was going to buy Bass the Brewer, Intercontinental Hotels, names that don't exist, because United Biscuits. That was what it was, and a lot of them were on 5-6 times earnings. 5-6% dividends. It's funny how a lot of those stocks are in that sort of position. So if you're paid 5-6% to wait, I mean, Persimmon, which again in the UK is getting up. If you're paid to wait, you can ride out these storms as a saver and an investor.
So we should mention Lindsell Train and Neil Woodford, because those guys came along right after, and they bought all those type of stocks, Reckitt Benckiser, etc., and AB InBev. And they rode them for 10 years plus, 15 years, until 2015, when they all sort of ran out of steam. But those guys made their careers on proper sensible stocks that had some growth and were reasonably valued and so on. And of course, now everybody thinks that they're idiots. Terry Smith, etc., complete idiot because he's lost money, and Nick Trainor's an idiot because he's lost money. You know, they're not idiots, but they're the type of things they like, which are real investments, and not SpaceX, I'm guessing, are not very popular. And so they've underperformed. And probably there comes a point where people thinking that they're idiots will reach some sort of crescendo, and that's probably the time you should be buying their fund, right? Because they're not idiots, but the world kind of changed around them and they stuck to their style.
I always think the pendulum swings, and interesting. I will have Nick Train on the show in I think July, so we'll
Tell
get
him
his...
I don't think he's an idiot. We don't think he's an idiot.
No, I know that. I know that. Okay, to wrap up, we've covered a lot of ground. So if someone is looking at this, how should they think about your fund in terms of, you know, sitting in their portfolio? Is it a sort of core holdings, a satellite holding? How do you sort of position it?
It's a satellite for your retail investors. They should be thinking about specialized thematic investing. It's active. One of the things when you look back to the data of running money, and funny enough, it's happened exactly with our model, which goes back to August, is when you look at every month, we'll either be first quartile or fourth. And the net eventually over time becomes a 1. That's because you're very different from what the market looks like. You're slightly contrarian as well by definition. And so it's more volatile. And some people, you know, can like that or not like that, but the ultimate aim is that you accumulate proper wealth over a 5-10 year period.
Yeah. Okay. And if there's one thing that you want to leave people with in terms of things that they should know about you or the fund, what would you say?
No, I think, look, we are 2 veteran investors who have been through these cycles/bubbles. And I think we will be looking for opportunities as opposed to index type investing.
I think what I'd say is since 2005 or 6, so let's say 20 years, I've been doing things in a kind of macro way, thematic thinking, thematic investing. And in that entire time, you don't want to brag, but in that entire time, there's been one macro event I got completely wrong. It was a big one, and I should have seen it coming, so that was annoying. But in general, the places I've worked, the teams I've run and so on, we have normally been on the right side of most things, up and down, actually. And so long may that last. And if it does, and if Peter and I can figure out a way through the weeds, then we should do well.
I have to ask you about this. We've got you on the show. Biggest market event that I can remember last Friday. I would love to get your take on SpaceX.
SpaceX, right. Topic du jour. The thing about SpaceX is that obviously it's obscenely overvalued. We all know that. But the interesting thing is the statistics are not in its favor. And the second issue is issuance, which we'll come on to next. So the first thing is, in US stock market history, ever, there have only been 3 companies that did 2 things at the same time. Number 1, market cap of $100 billion, at least. Number 2, trade at 100 times sales, not earnings, sales. 100 times that sales, 100 billion. So the first 3 were Snowflake, US software company, MicroStrategy, not quite sure how you define MicroStrategy, but anyway, you know it's a Bitcoin treasury company. And the third one was Palantir. 1, 2, 3. So what happened to those from the point where they got to those metrics were both ticked and the subsequent low. So Snowflake went down 80%, 80, partly because the CEO and the CFO left, having sold an awful lot of stock and went off to spend time with their family, but that's not a subject. MicroStrategy went down 75%. Bitcoin collapse and people realizing maybe it wasn't quite what we thought it was. And Palantir, last count, is down about 55 from the absolute high. So 1, 2, and 3 didn't go well. This is number 4, 125 times sales. We'll see, but it is 5 times bigger than Palantir was at its peak, which was the biggest of the 3. So it's big and it's incredibly highly valued, and we'll see. But the second thing is issuance, which I think people really haven't understood because maybe they haven't spent enough time thinking about it, or they're day trading, or they're buying call options or whatever. This transaction was the first of 10. There's going to be SpaceX 2, 3, 4, 5, 6, 7, 8, 9, 10. I don't think people have really taken that on board. It starts in August, 2 days after their numbers. We have an extra 30%, 30, coming to compare to the 5 and the 4 we already have. So 9% free float becomes 39. And then straight after that, day 70 through days 120, 135, there are 5 blocks of 7%. So that's another 35%. And then at the end, in day 366, so in a year's time roughly, everything else is unlocked. So this thing will be 100% free float, as opposed to 9 at the moment. So usually, supply and demand, when the supply of something goes up 10x from 9 to 100, it's not always good for share prices. And then the complicating factor is in the middle of all that, we have Anthropic, OpenAI, which will also have several transactions, number 1 through 10, depending on the lockups and so on. And then you have the hyperscalers, as discussed, who are issuing 50 billion, 40 billion, 100 billion here and everywhere. So what often brings bubbles down, one thing is interest rates, can happen, can be the catalyst. The other one is issuance. Yeah. Because companies just go, actually, this is completely crazy. We'll just sell stock because we can. And when everyone sells stock at the same time, if that coincides with perhaps a reduction in the general bullishness around AI or whatever, for whatever reason, Aaron Brockovich, who knows, you then have a proper problem. Yeah. So in the short term, SpaceX can do whatever, literally. I mean, it already has actually to some extent. It can go up, it can go down, it can do whatever it does. But when the excitement meets the actual supply, we think that's when the problems will start.
And to the point we discussed, if you take 3 to 5% being typical cash in a mutual fund and try and add it up and know what the market is, there's not enough money there for everything.
Yeah.
No, there really isn't. I mean, there needs to be 5, 6, 7 trillion, and 3 to 5% of 70 trillion is not 5, 6 trillion. It's like,
so it doesn't add up. It's, to use my elbow, saying there's more buyers than sellers. So when you ask why the prices, there could be more sellers than buyers. It's a very basic market psychology. There's not enough money.
Final thing, it says in the prospectus that 1 million people are going to go and build a colony on Mars. We think nobody's ever going to go to Mars, period. And Elton John and David Bowie and others had it right in their songs in the 70s. It's cold as hell and it's a very long way away.
Gents, thank you very much. So it's been fascinating. I think you've given a very good account of the fund, the themes, and hopefully we can get you back on the show when you've had a little bit more time to see how the world sort of develops. Thanks very much for coming on Vantage.
Thank you very much.
Thank you.